to people who are joining us. We might give people a little bit of extra time to join in, and then I'll start on this quarterly review because it's amazing how much I suppose can change in a quarter, and the current data and what's happening in the various markets around Australia seems to be showing us just that. So it'll be an interesting one in terms of some new developments that obviously are impacting not just investors around the country, but people trying to buy a home to live in, perhaps their first home. So some interesting things for all the viewers that normally join us. You probably know our background, but I will run through just a little bit about ourselves and the organisation for people that don't know who we are. And look, welcome everyone to the second quarterly review for 2023, and we'll see what's happening in the various property markets around Australia, both the capital city markets, some regional areas, and more importantly, I suppose, to most Australians, and naturally that includes Australian expats around the world, what's happening in the world of finance, because we all know that has, generally speaking, a fairly direct impact on what is happening in property markets as well. So without a lot of further ado, let's start on this quarterly review. Here's a disclaimer which everyone needs to read. This is just general information, clearly, so it's not personal advice, and if you require personal advice, then please don't hesitate to contact us to see if we can't assist you with your own personal set of circumstances. Just a little bit of background for people who don't know us. We have several different corporate businesses that have been established for many, many years. The original advisory business, Unicorp Partners, has been going for over 35 years now, and established that initially to assist my peers, so people in the medical profession, but then that branched out into other professions, and now obviously also has a niche market assisting Australian expats, both leaving Australia and repatriating to Australia, and sometimes in between. So that's the advisory business. Wise Guru is our international consulting business, which does focus on Australian expats around the world, and assists them with some of their finance and property needs. Aussie Loan Guru is a specialised lending business where we assist many, both of our domestic clients and Australian expats, obtaining potentially better outcomes than they would going to more mainstream providers of services like this. And Aussie Property Guru is the Australian residential property business. So that's a bit of background, and I guess the important thing is, people say, well, how can you help us? And most of our clients have generic needs in many respects, even though it's a niche area. So whether you're a surgeon or someone in the banking and finance sector, and whether you're in Australia or somewhere overseas, you probably suffer from some of the same sort of, challenges that we all have. We're all very time poor. Our clients typically earn higher incomes. They don't have as much time at their disposal to undertake research and all of the other things that we need to do, but they'd like to build their wealth in a conservative and an efficient, especially tax efficient manner, and would like to generally include some property in that mix when they're building their asset base. So they'd like some sort of third party assistance with that, and that's where we come in to help people with whatever their needs are. So we can tailor, if you like, our assistance relative to what your goals are. So we've developed a concierge service, which is basically a hand-holding service, if you like, to assist people. This is particularly important for Australian expats who, are a long way from home and may not be aware of what's happening at any given point in time. But also we find it's very important for people within Australia who may be professionals or otherwise, who are very, very busy and need assistance with what's generally speaking a fairly anxiety-producing set of events when you go and buy either a future house to live in or an investment property or try to augment your existing portfolio. So with all of that in mind, that's what we generally help people with, and we can tailor things specifically if someone needs to. So look, people will have seen this, and we get questions all the time. I do a weekly Q&A session, but the most commonly asked questions currently haven't varied a great deal from the last quarterly review, and it still revolves, to a large part about people saying, look, where is the official cash rate going to end up? And at the moment, we're getting more people saying, well, look, has the RBA stopped hiking? Has it not? I mean, it's difficult, I suppose, in many ways to predict these things with a crystal ball because no one has one. But it's important also from not just our clients' viewpoints and many viewers around the world, because they already have existing loans, and a lot of those are on a fixed interest rate. And as many people will know, that's coming to an end, has recently come to an end, or will do so in the near future. So, the other most commonly asked question is, what are we going to do? Should we stay on a variable rate? Should we try and fix again? How are we going to be better off? So that's also very, very topical at the moment. How will interest rates impact property prices? And we've seen, many commentators and experts, etc., give us their opinion about how this rise in the OCR is going to impact property prices, and just about all of them been totally wrong, really, to date. So I'll delve into that a little bit further with the data. Will inflation continue to drive my rental income? We'll go into what's happening there. People hearing a lot more about net overseas migration, and this is something we've been speaking about for, probably close on the last 18 months to 2 years, when we were sort of looking at what I predicted would occur once international borders reopened, and then look at, where some of the best opportunities are if you're trying to invest in this asset class. We all know that Australia's a large continent, so very important that people do their research or have someone do some research for them, because there are so many property markets around Australia, both capital city markets, but then all the regional ones, etc. So really important. And if we look at research, we take our data from the ABS, CoreLogic, Urbis, other national research institutions that provide this data. But it's really important, something I stress and we do, is that we do our own research with our own client base, and also try and put our practical overlay on the data, because having been looking at these things for over 35 years, you do develop some sort of insight into how to interpret the data. If you just look at data, quite often I think you can create a lot more heat than light, and you'll end up with the same outcome where you might burn yourself. So if we look at interest rates, and that's a question, how much further will they rise? Will they rise further? I think that at the current level of 3.85%, which is where the OCR is at the moment after the rate rise in May, I think that's already in somewhat restrictive territory, and I could see the RBA remaining on hold unless there's some surprise to the upside that really, I guess, forces their hand in relation to raising rates further. But the RBA has come out and said, look, we think that inflation has peaked, and certainly the flow of data does suggest that, but it's still higher, obviously, than their target band of 2 to 3%. So they're looking at ways and means of reducing demand, and we've seen that through goods inflation is coming down, but services are still holding up at this point in time, although I think as these fixed rate loans roll off, we can see already a softening in consumer spending data. employment or unemployment data. The latest print was softer than was anticipated. So I think these things are starting to flow through. There's still a risk to the upside, obviously, and we can see this in what's been going on an international basis. If we look at particularly the UK, which is not in a good position currently with inflation continuing to rise and rates continuing to rise. There's some debate about what will happen at the next meeting with the Fed in the US, and it's probably an each-way bet at this point in time. But I think there will be a further softening in demand, and probably one of the big sticking points will be what's going to happen to wages growth, and the other one is cost of rental accommodation, so cost of accommodation. But at this point in time, interest rates have been continuing to rise for all of us, for all borrowers, and that's ongoing at this point in time. Obviously, the rate of increase has diminished greatly, and we're certainly keeping a keen eye on this as we have more clients rolling off fixed rates. What do you do? It's a very good question, and currently I think it's also a bit of a each way bet as to whether you stay on variable rates or perhaps have a little diversification. Some banks may be offering a 1-year fixed rate, which you might find attractive. So it's important to have a look at each person's individual situation to see which way to best navigate that set of circumstances. And we're helping a lot of people with that at the moment. So for anyone that does think they require a little bit of input, then please don't hesitate to reach out. So one of the reasons I've been saying what I just have is that Australia has a far more sensitive base, I suppose, in relation to monetary policy, because most interest rate moves get passed through very quickly. In Australia, typically speaking, we've got 80-90% of mortgages on variable rates. Currently that's different because during the pandemic, obviously with rates coming down to almost zero, many people availed themselves of very inexpensive 2- and 3-year fixed rates, and some of our clients weren't fitted. We obviously looked at extending that and chose 5-year fixed rates. So they're still being protected from this current very fast, sharp increase in the official cash rate and variable rates with all of the banks and non-bank lenders. So that transmission has this time been stymied to a little extent in relation to pass through because of that. But if you look at that graph there from Westpac, you can see that the fixed rate mortgage expiry is gathering a great deal of momentum through the course of 2023, and I think that's going to continue to add to what would be a more normal situation there, and the consumers will respond. Even though, and I'll come to this later, it's worth bearing in mind that probably far fewer people than most mortgage holders would assume actually have a debt. So we'll come to that further in the discussion. Here's the latest weekly forecast from Westpac. So if you have a look here, they're expecting the RBA to stay on hold in June, as are we. And I think that various banks and various forecasters are looking at potential increases in July or August. Unless there's a real surprise, I don't see that happening. And I agree with this. And then early next year, we should start seeing a decline in the official cash rate as the economy slows and as the RBA needs to show some support for the economy in general. So if you have a look at these numbers, the other one is if you look at 10-year bond yields, they should also start declining. We've seen bond yields, especially at the short end, 2 years and under, move around substantially over the last quarter. They've been up and down like a yo-yo, and it's been pretty difficult to, I suppose, predict what's going to happen in this instance. But overall, I think both here and then perhaps more quickly in the US, we will see a decline in the yields as the economy slows and the impacts of this rate rise cycle start taking their effect. If you look at the exchange rate, which is again something that many of our international viewers, Australian expats, look at, it's pretty important, and we can see there that the prediction from Westpac is that the Aussie dollar should improve again over the course of this year and next year. A lot will depend, upon, I suppose, in the shorter term, from a volatility viewpoint, if we are going to see some kind of risk-off situation, market volatility, pullback in equity markets, etc. That will tend to lead to the Aussie dollar declining in value against particularly the US dollar. But at this point in time, the Aussie dollar is at sort of pretty much a low point, and may get hit if we have a CPI number that's a bit of a rogue number currently, but I think this is all volatility that we just have to look at, and the overall direction should be on a path that's going to improve over the balance of this year and 2024. So let's have a look at immigration, one of these other questions that people are now asking us a great deal about, and people who have watched our reviews over previous quarters will know my thoughts in relation to immigration, and they've been proven to be correct, where I was saying, 18 months ago and 12 months ago, when international borders reopened, I thought that the ABS actually had got their forecasts perhaps a little bit wrong, and that Australia would present a very compelling destination for many people from overseas who wanted to migrate after some of the ravages of the pandemic. And that's proven to be the case. If you have a look there, we've had some of the highest quarterly net overseas migration numbers recorded on record. And this is a lagging indicator anyway. So I think that's going to continue, and it's going to pose some other challenges and some other benefits for Australia as a whole, for the economy, people living here, etc. And then if we look at state and territory populations and also interstate movements, which we do, because they have a massive impact obviously on property demand, on housing demand, we see that again there, and you'll come see this later. For example, Queensland has probably been the strongest currently, and there's a 1.5% growth rate factored in there. Well, currently that's running at about 2.2. So some of these numbers, again, I think the statistics may prove to be greater than has been predicted at this point in time. Queensland and WA, I think, are the states that are leading this charge in interstate migration. We'll come to some more numbers later on, and I think that'll continue. So the other thing that's an important indicator is how much new lending is occurring in relation to property purchases. Even more important now, because as the official cash rate's gone up, the serviceability rate that banks need to use, and once they include the APRA buffer, have gone up towards 10%. So, pretty important, as we see here, that rose by just under 5% for the last set of numbers. And we can see now there's an uptick for both owner-occupiers and investors, and I think that's starting to flow through just in general terms, confidence in the market. So if we have a look at the flip side of that, and the regulators obviously do, APRA does, and that's in relation to what they term riskier loans. So when we speak about that, generally speaking, it's, and these are arbitrary numbers really, where the regulators and lenders look at a debt-to-income ratio of greater than 6 being a risk factor, and that fell to 11%, down from 23.3% in the September quarter. So that's a pretty big decline, obviously, and loan-to-income ratios of 6 or more dropped to 4.5%. From 7.3% in October. So as we can see, if you look at that there, the risk factors are declining, I think, quite substantially. And one of those things would be that if people are trying to get a loan currently, they would know that it is quite difficult to expand your borrowing capacity given the current serviceability rate constraints. So let's have a look at property as an asset class. It's a fairly large one, and it's a great topic of conversation for Australians living in Australia or for Aussie expats living abroad. If we look at national dwelling values, over the last 12 months they've declined by 8%. But that's a generic number, so let's look at some more valuable, I suppose, insights, and that's something that we have to glean from the data that's comprised both state, territory levels, capital city markets, etc. So if we have a look at the quarterly situation, national home values actually rose by 1% over the last 3 months, and I'll have a look and show you the difference between some of the various major markets and how they've fared through that, because capital cities have risen at a different rate to regional markets, and different cities again have performed quite differently. So let's have a look at those. If you look at it on a quarterly basis, I think most people can see the shape of that graph there. There's been a very substantial rebound in the last quarter, in the last 3 months. And if you look at where that's occurred mainly, Sydney has certainly been the standout there, where values have increased by 3%, and then we'll look at more granularity within that to see what sectors perhaps have outperformed. And here, if you have a look at this here, it's the top quartile that has gone up the most. So that also led the decline, mind you, over the last 12 to 15 months, but you can see it's a very strong rebound. And we're seeing it from our client base. People finding it very difficult to buy property in Sydney. A lot of people looking to perhaps buy their first homes or change their existing accommodation. And it's just really hard, or they're finding it really hard, to find any quality assets to purchase. So a very tight market, and we'll come back to that. But as you can see, things have stabilised everywhere except Hobart and Darwin, which is still showing some reasonable rates of decline. So one of the key things that's driving all this is supply and demand. And it was one of the things that I said probably a year ago, that as rates increase, what's going to happen is that supply will start drying up, and that's exactly what has happened. So people that own property are choosing not to sell unless they really have to. So you've got a big diminution in the ability to actually buy a new home or to invest in new property, and that I think is going to continue, and I'll give you an insight into why. But if you look at monthly dwelling approvals, they fell slightly in March, and I've just got the latest figures in yesterday for April, where they've especially in attached dwellings, so apartments, townhouses, etc. They're down at 11-year lows, and that's really an issue. I think this supply issue is going to be exacerbated, especially in, say, the East Coast capital city markets, due to this high level of immigration from overseas. And that brings us to rental markets. And as most people know who are living, especially in those regions, trying to find somewhere to rent is very, very difficult and very expensive. So, as I spoke about earlier, that's going to continue to put pressure on services inflation, cost of accommodation being in that basket over coming quarters, because I don't see that being alleviated in any way, because there's no real new supply coming to the market. So unit rents have sort of plateaued since last set of numbers, but within various markets and subsectors of that, if you have a look at the bottom of the screen there, capital city markets have seen really, really strong increases in rent, and that's causing a lot of issues for people seeking to find a place to live in, which they don't own or don't have the ability to buy. So Australian gross rent yields were steady at 3.9%. They came from a low of 3.21 at the beginning of last year, and it's now the highest rental yield since November in 2019. So look, great if you are a property owner or someone that's already built up an asset base of properties, because clearly that's adding to your income stream and will, in many cases, assist in trying or mitigating most of the increased cost rising from interest rates, in relation to holding those assets. Some people obviously have less debt than others, so it just depends again on everyone's own situation. But if we have a look at the data and what can we do with it, how do we utilise it, it's a bit of a task, because we were talking earlier, an Australian residential property really does underpin the nation's wealth, and it's a large number. One of the interesting things, I suppose, that many of our viewers or people in general don't really recognise is that about a third of Australian residential property is owned outright. People don't have a mortgage on that. So for that cohort, quite often there might be an older age bracket, they're getting an increased, I suppose, return on cash they may have saved up. So that's certainly not going to weaken demand. It may fuel demand, but anyone that does have a mortgage thinks that everyone else is in the same position as they are, and they're not. So if you look at that, it's only about 23-24%, 2.2 trillion of outstanding mortgage debt against 9.5 trillion of asset value. Something worth thinking about. And say roughly a third of people rent properties. So again, they're not lumbered with increases in the official cash rate and banks passing that on to them. You really need to think that through. And the question I always have asked, particularly overseas, is what's happening in the Aussie property market? Well, as all of our viewers know, there's no such thing. There are a myriad of property markets within Australia, and we can't cover all of them, but we certainly try and have a look at the major ones. So if we look at this as a bit of background information, it's really important because, as I said, most forecasters and economists have been proven at this point in time quite incorrect in relation to what they considered was going to happen to house prices during this hiking cycle. And if we look back here, peak to trough declines have been getting larger, and this I anticipate will be the largest one, but nothing like the 25 to 35% declines that were commonly mooted in the media. RBA did some modelling which again was even further out than that, 30 to 40%, and some of the bank economists obviously were also in that realm, but that hasn't come to pass. As we've seen over the last 12 months, national home values are down 8%, and they're down, as we said, in the Sydney market, they went down further than that, but we'll have a look at the data now, and they were still contained within that 10 to 15% decline. So the other thing that's important to look at from a historical viewpoint is what happened to housing prices during prior tightening cycles, and you can see that was quite mixed. Some shallow declines, longer and more shallow declines, some upticks, and the longest one obviously was actually quite robust for housing prices. So we look at some of the macro factors, I suppose, that overlay on on interest rates as well. Clearly interest rates have a very important bearing on asset prices, but I think housing, being not just a commodity but being a human necessity, tends to react differently, and that's where I think practical experience over decades does help when we're looking at what may or may not happen, and I think we've been closer to the mark than most people. So if you have a look at supply and demand here in listings, so people putting their properties up for sale, we can see that there's definitely a massive decline in that, 27% lower than the 5-year average. That's that blue line there in the current year. So it's trending much lower, and you just need to speak to anyone who's looking to buy a house, especially let's say in the Sydney market. They're finding it really difficult, and I'm sure if you're looking for one yourself, you probably can tell people exactly that situation. So these were some of the downturn scenarios we've been looking at over the last couple of quarters, and it really brings out how the different capital city markets have performed over this period of time, where Sydney had a very large uptick and then a pretty sharp downfall. Melbourne was a little bit more sanguine in both ways. Brisbane had a very large uptick and again not a very large downtick. Perth sort of rising to an all-time high, but I think now looking at these drops of 15% or 20% or 25%, people are not doing that anymore, and this whole situation where everyone was quite, I suppose, frightened in relation to where housing prices would end up with this with this really fast level of increases that the RBA was pushing at consumers. So it's a situation that has changed a great deal, and some of the latest data which we'll go through now I think will add more comfort to most people who aren't actually actively looking in the market, that things are not what they seem to be, and that the situation has played out in a far more benign manner. So this is another set of historical numbers that we like to have a look at, just to give us a bit of further insight. What happened to house prices after the last interest rate rise in cycles. And if you look at the house price change after 1 year after the last hike, 2 years and then 5 years, probably the 5-year number is the more important one, but people will obviously look at 1 and 2 years. So if you look at these 4 cycles, you can see there's quite a bit of difference from minus 4.6% in the 2002 to 2008 period to plus 14 in 99-2000. But then if you look out to the 5-year situation, house price change 5 years after the last hike, up 26.1, 13.5, 64.3% and 26%. And I think most people should be able to get a reasonable amount of comfort. I've had to speak to people who have bought, say, a new home that they wanted to live in over the last couple of years, and they might have said, oh my God, I've bought in at the top, I've paid too much. But the reality is that this volatility can play out differently, but I don't think they're really in any sort of distress, and they can certainly manage to still pay their mortgage repayments, because the Australian banks have been really robust in their credit assessment. And just ask anyone looking for a loan, it's difficult to overborrow. So the other side of the equation, people say, how should I invest in property? Where should I buy? And we sort of stick to a principle that's as easy as pie, and that means you've got an area where you've got population growth, infrastructure growth, and employment growth. So if you're buying in an area like that, you're obviously going to do far better than someone that hasn't thought about those macro drivers of housing demand. Now, if we have a look at the states, the various states, some of the capital city markets, which we'll do now, it brings that out. So if we look at Sydney, New South Wales has the most diversified and largest economy in Australia. There's still, and one can say this because, no one has a crystal ball, so if there is further pressure on rates due to sticky inflation, etc., the greatest downside risk is still in Sydney due to affordability, and that hasn't gone away, but we can see the impact already in terms of downside and now upside. There's a huge ongoing demand for quality dwellings, and that's only getting worse rather than better. We've seen a decent, strong quarterly rebound in house prices there, and I think as net overseas migration continues to drive higher, this demand for property, especially for rental property, is going to intensify. So if you look at the numbers to the end of April, Sydney was up 1.3% for the month, 3% for the quarter, and it's down 10.7% for the past 12 months and 11.2% beneath its record high, which was in January last year. So that gives you a pretty good idea. It's showing the greatest level of volatility. If you look at Melbourne, population is growing there again. It had an outflow of population during the pandemic due to massively extended lockdowns and many other factors, but it's still the cheapest capital city market to rent in currently, and the pace of declines has flattened and it's increasing. So it also is seeing a return of overseas students, and they've always been really important in the Melbourne market, and that again is intensifying pressure on especially inner city rental accommodation, and will continue. So if we look at those numbers, you can see Melbourne was up by 0.1% last month, 0.3% for the quarter, down just under 9% for the last 12 months, and it's down 9% from its peak. So as I said, a less volatile market than Sydney by a long shot, but it's showing good signs of stabilising as well. If we look at Perth on the other side of Australia, Perth is also getting a good amount of interstate migration. That's being driven, I think, by the commodities employment strength, like most capital city regions, low vacancy rates. It's had a good, I think, more than modest, really, 1% quarterly rise, and that lack of diversification in the WA economy is continuing to play out and assist with housing values and also on housing demand. So if you have a look at Perth, it was up 1% for the quarter, 0.6% last month, and dwelling values have increased 1.3% over the last 12 months. And if you look at that, Sydney's down 10.7%, so big variation, and Perth values are at a record high. And don't forget, Perth sort of peaked back 8-9 years ago during the mining boom, and then languished for a long time. So a totally different market to the East Coast capital cities. So we ask this question quite often. People say, "Look, shall I buy an old property or a new one?" And there's no definitive answer to that, because neither is right or wrong. If you look at buying an old property, you could potentially add value to that by renovation or by redevelopment, but you've got to have the skill set and the time. Most of our clients being either professionals within Australia or Australian expats tend not to have that. So, they're very busy, they're time poor, and they don't necessarily work in the construction business. So it's just horses for courses, and most of those people will usually prefer a new property because you don't have the issue of repairs and maintenance that you will in an old property. If there's anything major, obviously builders have warranties that they have to give within most states and territories in Australia. You'll generally get better tenants because they seek out those higher quality, more luxurious abodes, and it's easier to rent those and to manage those, and that's what people want. Our client base basically wants, a no-touch scenario, but you can't have that. So a low-touch scenario where you don't have to contact, or be contacted by tenants or property managers constantly needing something in terms of repairs, maintenance, etc. So, horses for courses, as I say, but the other benefit, I suppose, and that's fairly, what is unique to Australia, is that we have these two provisions in the Tax Act, Division 40 and Division 43, which are our depreciation allowances. So they will give property owners the potential to have deductions against their assessable income through non-cash items. So, if you buy a new property, you can deduct 2.5% of the building cost every year for 40 years. And similarly, on fixtures and fittings, Division 40, if you get a quantity surveyor's report done, you can deduct those items, the various half-lives each year against your assessable income. So these are non-cash items, and they help people a great deal. Especially if you're living onshore, because if you're an expat, you have to save up the balance above, I suppose, neutrally gearing something. So either way, you've got a pretty good outcome. So the numbers really have been pointing to Queensland, southeast Queensland in particular, for some time. That's ongoing. And Queensland does have a diversified economy. It really is comprised of segments which are very much the same as the national economy, rather than just being a mining state. The work from home lifestyle factors have really come to the fore. That was happening before the pandemic, but that's really, I suppose, gone a lot further after the pandemic, where people now also have the opportunity, because employers are adopting a more flexible attitude to work from home. So that's enhancing the desirability of some of those coastal regions in particular. And it's created an even more substantial value gap these days, especially if you look at Sydney and Melbourne. So, in a nominal sense, that's actually expanded in some respects rather than contracted. And then if we look at the interstate migration numbers, which, as I said to you earlier, were running at over 2%. That's the highest it's been in well over 15 years, and seems to be strengthening each quarter that I've seen so far over the last 4 to 6 quarters. So we also see that continuing. If we look at Brisbane, it's up 0.3% for the month, 0.1% for the quarter, so pretty flat, down 9.8% for the last 12 months, and down 10.7% from its recent peak, which was substantial as property values moved up over 40% in that region over the prior period of 2.5 years. So important to look at all those numbers. Here, this is what we're looking at in terms of interstate migration. So as you can see there, Queensland 2.2% and Western Australia 1.8%. Are the standouts in terms of the largest net beneficiaries of internal migration within Australia. And, at least everywhere is showing positive signs now, where, as I said prior to that, Victoria was suffering a net outflow. So it augurs well for the country as a whole, but it's still important to recognise that there are some fairly large differences in relation to some of these major residential markets within the country and the amount of people moving within the country itself. This gives you a pretty good graphical picture here. If you can see, New South Wales here, the outflow, the dark blue bar, Victoria, and most of that is obviously coming from the capital cities, so Sydney and Melbourne. And if you see the influx, you can see that, Queensland is pretty much a beneficiary of all forms of population growth, and that looks like it's going to continue. We'll keep an eye on it, as we do on every quarter, but I think it's a fairly strong situation in relation to that ongoing demand and the value gap that exists. Then if we look at the second part of that easy as pie, infrastructure, look at existing infrastructure, and I think I often look at this If you look at road systems between Brisbane, particularly Sydney, there's a lot of infrastructure that's been built in Brisbane, for example, that will continue to cater for the expansion of that city and the population of that city, which in Sydney is pretty difficult to catch up to. We've got issues in Sydney that we really can't outgrow, unfortunately. So there are those things, and then you look at new projects that have been started, that are close to finishing or have just finished. And there's a lot of infrastructure being developed in most Australian major capitals, but certainly so, in Brisbane and Brisbane Airport, for example, which finished over 12 months ago, but now has a throughput capacity of, say, Changi in Singapore or Hong Kong. These things now, post-pandemic, are going to start really becoming important and play into this, which is the fact that Brisbane is hosting the 2032 Olympics. It's now 9 years away, so some of those projects have begun prior to the city winning that Olympic bid, but now post that there's going to be far more infrastructure development that's occurring over the ensuing years, because it can't happen just before an event like this, which goes for several weeks. So it's an ongoing situation. It's going to provide a large increase in both direct and indirect employment sources. And if we look at what happened in the Sydney Olympics, it should also augment what's already happened on a more macro basis in terms of interstate migration, overseas migration, and valuation gap in general. So I think these are all positive tailwinds for the housing sector there. The big issue is supply, and I think that's the same, as I said, in most of the Australian capital city markets. So if we look at what is the value proposition, well, it's trying to help people not make these common mistakes that people often do. And we see it particularly with Australian expats, where they've been overseas for some years and they've been really busy and they've got to look after their family. They do a lot of travel and they don't have time to do anything. So they've had a build up in cash. That hasn't really done anything, especially when we've gone through those last 2 or 3 years of virtually zero interest rates. So they just want to invest in something. Well, any investment won't do. So you've really got to be careful of not just having a knee-jerk reaction. You can't ignore your point of difference. You should have one. There's no lack of information or research. I mean, there's so much available these days on the internet that you could spend each and every day going through that. But I think unless you know how to dissect that, and as I say, benefit potentially from decades of practical experience, you can cause yourself sometimes more harm than good. The other thing is waiting too long to invest. And I've seen this over the years, but more importantly, I'll add that at this point in time, we've seen viewers around the world, Australian expats, ride this cycle. They've been wanting to buy property, particularly say in the Sydney market, and they've always been underbidders at sales over the last 2 years on the way up to maybe, who knows, pick a number, 3 million. And it's still happening on the way down, where it may be now 2 million because your borrowing capacity has decreased significantly. But I think it's important to make the right decision. And as I said, with other people who did make that decision, I don't think they really had to worry about this sense of I may lose on this particular transaction that I'm making, because if we look at those numbers, both 1, 2 and 5 years after the last rate hike, we see that housing prices tend to have rebounded quite strongly. So I think people often need to be careful, and rather than buying into a strong market, because that's when people will buy, they need to buy into a strong market of the future. And the way to work out how to do that and where that may be is to utilise research, rather than just buy into the most popular spot because everyone else is doing the same thing. So the sustainability thing, or this, we'd say unique attributes of assets are really important. These are just some generic examples. So, I've picked out there Port Hedland because that's an economy that relies simply on iron ore exports. So it's one of these sort of single theme economies which can be extremely volatile. It was something that was marketed over the years as positive cash flow situation, etc., etc. But it's really quite, it can be quite dangerous and often creates some really poor outcomes for people who are investing there. And the other two, whether it's say Docklands at Melbourne or Surfers Paradise, be careful of what we call it investor grade. So they're usually lower quality assets that are cheaper, smaller, quite often one bedroom, that are marketed to people because of those factors. They are cheaper, but unfortunately they may be in a building of 800 or 1,000 apartments and 600 of them are the same. Would an owner-occupier want to live in there? Probably not. So when you go to sell it or rent it, you've got no unique set of differentiating factors, and I think that's also going to impact obviously on future capital growth and your overall outcome over time. So things to be aware of. Then supply and demand, very important. We look at further granularity within markets. This is just a snapshot of what's happening in Brisbane, and as we can see, the supply side of things has really diminished. It's really hard for builders now to be able to build new dwellings and make that work for them on an economic and commercial basis, and hence this is really hampering this new supply even further, and that's impacting both obviously people who are wanting to buy something and people also then who are wanting to rent something. And we look at then within markets, different regions, and as we can see, the inner east and the inner west are probably the lowest amount of future supply coming up there. So we look at those situations in most markets, and coming back to that also is this, not only do we have this real lack of supply that's coming through, but what do people want? And again, the pandemic has probably exacerbated that. And people want larger, oversized apartments. If they're going to live in an apartment, they'd prefer to have 3 bedrooms if they could afford it, or otherwise 2 bedrooms with a multi-purpose room so they can work from home, have a study or home office. All these things have come to the market, I suppose, over the last 3 years during the pandemic, but that was already happening beforehand. I mean, a lot of people who want to downsize from their freestanding home in a suburb, their kids have grown up and left home, they would generally like to stay in the area they've lived in potentially for decades, and move into something that has more security, amenity, ease of maintenance, etc. And they also have the money to spend on these high quality, larger boutique style assets. So you just have to find them. And that's not that easy. So tying it all together for people, as I said, the easiest pie, we look for population growth, infrastructure growth and employment growth. But you also really need to focus on, what are the unique attributes of the property that you're purchasing? Is that sustainable into the future, and why? Look for some underlying macro trends that are sustainable. Make sure that there's strong economic activity in the future. And that's what I'm saying, buying into a strong market of the future, not necessarily buying into something at the top of the market whenever that may be, when you decide to do so. So they're all really important things, and it's hard to put it all together, but generally speaking, we find most people can do with some help with tying all that together. Here are some examples of various properties that we look for. These sort of, as I said, oversized boutique owner-occupier style attached dwelling or apartment buildings, coastal markets, particularly in southeast Queensland. Sunshine Coast and the Gold Coast have been very sought after and difficult to obtain higher quality assets there. Modern high quality townhouses, again, many people looking for these, but very difficult to find because they usually have to be built in what's termed infill land in the various capital cities, and that's both expensive to produce and difficult to actually find. You'll see, quality of finishes. People are looking for now, if they can get that, the amenity potentially of more resort style living within these sort of boutique dwellings, and just the level of finishes, ceiling heights, double glazing, amount of glass. It's really, I suppose, people looking for more quality. If you're looking at, say, this is a Gold Coast, and anyone that's been there knows that it can get fairly windy in areas like that. So looking at enclosed communal spaces to give you that expansive outlook over the ocean without getting blown away, things like that are important. And different locations have different regional nuances, so it's important to know what to look for. This is something at the Sunshine Coast, which again has been a market that's been very strong for people. Brisbane, southern coasts, and then we look at numbers. We help people assess a situation, so we look at the quantitative side of things, the cost of acquisition, then the ongoing cost of ownership of a particular property, and that changes obviously from a net viewpoint depending on whether you're a domestic tax resident or you're an Australian expat living offshore. But in generally in a cycle, it sort of ends up looking like this, where most people, if they choose a property that has all those features, etc., they look at maybe paying around 6%. The offsets from the tax office pay for around 21%, and the tenant for around 73%. But if you look at the situation from a non-resident's viewpoint, from an expat's viewpoint, you may not have sufficient ATI, which is Australian taxable income, and that's generally derived from your rental income, to spend all of their tax savings. So they get to keep the rest of those. Those tax credits don't have a half-life, and they get to utilise those when they repatriate. So especially if you're coming from a low-tax environment or a no-tax environment, that's fairly attractive for people who are repatriating to Australia, and gives them an opportunity to enter that situation perhaps in a less difficult manner, or they can use those credits if they ever choose to sell an asset and offset any capital gains tax. So certainly great benefits to have either way, whether you can use them immediately or use some immediately and defer the use of the rest till later. This is something that I've shown people for some time. I mean, property really is an investment situation rather than speculation. People sometimes want to choose to do that, but it's not the right way of looking at things, because as you can see, really, you don't have to be a rocket scientist if you do your research up front and buy quality assets in sought after locations and keep them. Then time will do a pretty good job for you from an investment viewpoint. Continue to keep that asset long term, and it also serves the purpose, I suppose. People often say to me, what do I do about capital gains tax? Well, if you don't sell something, there's no taxing event that has occurred, so you don't pay any. So lots of reasons, if you've got great assets, to keep them. Quite often, or the numbers show us that the majority of people sell things at a time where, sort of between 4 and 8 years of purchasing something, they're not going to get, obviously, the outcome that they deserve by just keeping something. And then, of course, you've got to pay the tax and think of a better place to put those cash assets to work. So one of those things that you really need to look at, and we can give you more insights into that on an individual basis because everyone's situation is different. But let's have a look at just, to finish up, I mean, what's the difference? What can we do? We can help people with many things, but one of the important ones, I guess, is for many of our clients, especially so for Australian expats living overseas. We can generally help them with up to an 85% loan to value ratio without paying mortgage insurance. And if you're buying a property for $2 million or so or more, that could mean that you can save yourself, up to $40,000 or $50,000 in mortgage insurance, which would just be paid to the bank for no reason other than you wanting to borrow that extra amount of money because you may not have sufficient capital to pay the 20% deposit plus stamp duty to obtain the actual property asset that you want. Or if you're a property investor, clearly it helps you to diversify and build your portfolio in a far more efficient manner and in a quicker time frame. So they're really important issues. We look for sustainable properties that have exclusive access and therefore features, and help people to use their legitimate tax deductions in the most efficient way, so that generally speaking you could end up with a situation where you're paying no tax within Australia unless you build up a portfolio of perhaps say 6, 7, 8 properties, and that then may change. So without further ado, if we have a look at that, we look at 4 steps to effective investment in that asset class, and we can give individuals assistance by looking at your own particular set of circumstances and then going through and assisting with that whole situation. As I said, we have that concierge service available if people want to avail themselves of that, so that we can actually take the sting out of most of the anxiety producing situation, which as you come towards settling a property is usually around obtaining the right loan, having that available at the right time, and making sure that all the other situations all meld and settlement happens efficiently and on time. So we've got a whole list of professionals within those sectors that we can let people be introduced to, and they can assist them with those situations depending on the state or territory that they're looking to buy something in. So look, if those things are of value to people viewing or looking at this online, then by all means reach out, email us or call, and we can have somebody contact you and see whether we can arrange a Zoom meeting or some other way of helping you with your own personal affairs. We'll send out a survey, so please, if you would, fill that in for us. It always helps us, assists us to try and make adjustments or changes for future online events or how we do things. We'd really appreciate that. And now we'll have a Q&A. If anyone would like to ask any questions, I'm more than happy to answer them. Does anyone have any further questions that we haven't covered during this session? Please let us know. Otherwise, as I say, just email us or contact us online, and we can come back to you and we can go through and help you with your own particular question or set of questions that you may have for us. Otherwise, look, thanks very much for joining us, and all the very best. We'll see you either at next week's Q&A or the next quarterly review. I'm Andrew Unterweger. All the best.